Treasury yields surged past 4.6% in Tuesday's pre-market session, pushing the benchmark 10-year note beyond a key threshold. This move is creating headwinds for growth-oriented technology shares, which are particularly sensitive to rising borrowing costs. As yields climbed, Nasdaq 100 futures fell by about 0.8%, S&P 500 futures dipped 0.4%, and Dow futures lost 0.2%. The decline in equity futures reflects investor concerns about the impact of higher rates on future earnings and valuations. Inflation anxieties are fueling the bond sell-off, with rising yields signaling tighter monetary conditions. This is especially problematic for AA-focused companies and other growth stocks, which rely on low-cost borrowing to fund long-term projects. Elevated yields can dampen enthusiasm for these types of investments, as higher borrowing costs reduce the present value of future cash flows. The Federal Reserve is under scrutiny as it weighs its next move in an environment of rising inflation and geopolitical tensions. Recent blockages in the Strait of Hormuz have raised energy costs, adding to the uncertainty about whether the central bank will pivot toward tighter policy. Investment professionals are actively debating the trajectory of interest rates, with any move toward higher rates posing a significant challenge for growth stocks. Meanwhile, crude prices retreated following President Trump's announcement of halted military action against Iran and ongoing diplomatic discussions. This development could ease some inflationary pressures, but it remains to be seen whether it will. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Be enough to offset the broader market concerns. The coming week will be critical as investors await NVIDIA's quarterly results, which could serve as a turning point for artificial intelligence investments and overall market sentiment. Bank of America's latest fund manager survey highlighted global chip stocks as the most overcrowded investment position, suggesting that any negative surprises could lead to a broader sell-off. Equity futures traded lower during Tuesday's pre-market hours, continuing Monday's negative momentum. Technology shares bore the brunt of the selling pressure, with Nasdaq 100 contracts falling roughly 0.8%. S&P 500 futures declined 0.4%, while Dow Jones Industrial Average futures lost 0.2%. The benchmark 10-year Treasury note yield advanced beyond the 4.6% threshold, maintaining pressure. On equity valuations, elevated borrowing costs typically dampen enthusiasm for growth-oriented investments, with technology companies particularly vulnerable to rate fluctuations. Inflation anxieties continue fueling the bond sell-off. Recent blockages in critical shipping lanes through the Strait of Hormuz have elevated energy costs, sparking questions about whether the Federal Reserve might pivot toward tighter monetary policy. Investment professionals are actively debating the central bank's likely trajectory. Any movement toward higher interest rates would create significant challenges for AA-focused companies and other growth stocks, whose market valuations depend heavily on low discount rates. The next signal investors should watch is the outcome of the Federal Reserve's upcoming meetings and the release of key economic indicators, such as inflation, data, and employment figures. These signals will provide more clarity on the central bank's stance and help determine whether the current sell-off in growth stocks will continue or reverse. Until then, the market remains in a state of flux, with Treasury yields acting as a key barometer for investor sentiment and risk appetite. The stakes are high for investors who have heavily allocated to high-growth technology companies, as even a modest increase in interest rates could significantly impact their valuations. The mechanism at play is straightforward. Higher yields increase the cost of capital, making long-term growth projects less attractive. For companies that rely on future cash flows to justify current valuations, this can trigger a reevaluation of. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Their worth. The broader implications extend beyond the tech sector, as the interconnected nature of global markets means that shifts in Treasury yields can ripple across asset classes. Investors are also keeping a close eye on geopolitical developments, as any renewed tensions in the Middle East could reignite inflation fears and push yields even higher. The combination of rising rates and potential geopolitical shocks creates a volatile backdrop for markets. As such, the coming days and weeks will be crucial for gauging the direction of both Treasury yields and equity prices. Until more clarity emerges, the market is likely to remain sensitive to any new developments, with Treasury yields serving as a leading indicator of investor sentiment.